FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. It's February 7th, 2018. Well, you've seen amazing volatility in the last 3-4 sessions of the market. You know, volatility was down near record lows. Complacency had set into the stock market. There was no risk. Just buy and wait for the stock to go up. All of a sudden, volatility goes from 10 to 50, which is a 5 times increase in volatility. What does it mean for the future? That's what you want to know, and that's what we're going to be talking about. First, as always, join the show. Be a part of it. Email us at kl@kerrylutz.com. So is volatility back? Is risk back into the market? Is it going to be priced? Well, Jason Carrier, you are with us now, partners with our good friend David Scranton at the Scranton Financial Group. And Jason, welcome to the show.
Hi, Kerry. Thank you for having me.
So volatility, the V word, seems to be back.
Yeah, it seems like it. And you had mentioned the VIX earlier. It's the volatility index is volatile. So, you know, we had it spike up near 50 yesterday, and it seemed to settle back down into the 20s. But still, it's off a low of, as you had said, around 10. So unfortunately, volatility is back. And that V word is the one that scares almost everybody. From Wall Street to Main Street.
Except seasoned traders, they love volatility because either way, no matter how they bet, generally with the volatility, their bets are going to pay off. But for the average person, for you and me, it's a lot different with volatility. It's something to be avoided and something that many of you investors out there really fear.
Yeah, absolutely. As you had said, the average investor is typically, they're taught to be a buy and hold investor. We try to temper people and to not make rash decisions. We saw yesterday, and we're kind of even seeing it today, the whipsaw effect of, everyone dumping, getting the fear set in, everyone dumped their stocks and then it snapped right back. And as you said, very few people profit from situations like that. So, I hate to sound like everybody else, but at least for the short term, we don't want to see the volatility where it's at. But we also kind of want to see how this plays out over the next maybe week or two.
Well, a lot of people out there have made a lot of money. If you had bought at the bottom in 2009, kept all your money in there, reinvested whatever dividends you might have gotten, you've seen your money quadruple. And then all of a sudden you see how fast your returns can disappear. 1,800 points in 2 sessions. And that's got to be a wake-up call to a lot of you out there. It's got to be a real reality check.
Yeah, absolutely. I'm going to throw another word out, and that's a Meltup. We certainly experienced that. So I actually wanted to see a little correction. What we saw certainly wasn't something that any of us wanted to witness, but we did need it simply because when you get that Meltup effect, people are jumping into the markets, not for any fundamentals or earnings or corporate good news. They're simply jumping in for the because they don't want to miss out on any sort of loss of gains or anything like that. So that's kind of what we saw certainly over the last year or so. When Donald Trump was elected, the markets took off, and rightfully so. They felt that the markets were pricing in the tax changes or the new tax reform. But the problem happened when the reform was actually put into place. Well, the market took off again. We actually had one of the best Januaries here in 2018 that we had in history. And that's that Meltup effect. The tax reform was already priced in. We didn't have to do it again. And so we needed that correction to kind of stem those investors that were just dumping money into the markets for the sake of doing it with no backing behind it.
So glad you mentioned tax reform. It's not like it just had a one-shot effect. I mean, obviously the market was anticipating it. I think you could make that argument in light of its increases, its rises over the past year since Trump was elected, and maybe even it was sure of it after the healthcare reform, Obamacare repeal debacle. But the Tax Reform Act has had a lot of unintended consequences, like all these bonuses and raises for employees and increased investment and and just, perhaps increase stock buybacks, but we really haven't seen that yet. But it looks like a refocusing on investing profits, corporate profits, into opportunities here in the U.S. Is that fully priced in, or is that yesterday's news, or can we still look for surprises on the upside from it?
I do think it was priced in. Since the election, we saw, and before the correction, we saw about a 40% increase on the Dow over the course of Donald Trump's, transition to presidency. And so a 40% increase really drove up market capitalization of companies. We had a PE ratios on the Dow were approaching the high 20s, and that's high. When the average is in the middle teens. So we did, I believe, price that in. The problem now is that it takes time for corporations, for their earnings to catch up to the price and to get those PE ratios back down. And with time, a lot of things can happen. There's a lot of financial skeletons, a lot of mousetraps we need to avoid. And look what just happened here last week. Actually, good news came out, and we had this the jobs report, and you have this cascading effect all the way down to the stock market. The good jobs report, possible inflation, possible increase of short-term interest rates quicker than normal. That cascaded to long-term interest rates, and then that cascaded down to the market kind of having a serious correction. So I do believe personally that the markets are priced into the tax reform. These companies just need not a year; they probably need years to sort of catch up to the earnings, to catch up to the price capitalization that they've already seen.
So you mentioned, Jason, increasing short-term interest rates and long-term. I mean, the mortgage rate is up over 4% now, at least according to ads I hear on the radio. Interest rates rising interest rates. We're still well below the historic norm, which is 5% or 6%, depending on how far you go back. Interest rates have the potential to derail this whole thing, don't they?
Yes, absolutely. And that's sort of the fear, not the fear, but that's sort of what we're watching. And again, I believe long term, we're going to see a flattening stock market while, again, earnings catch up. And one of those mousetraps or skeletons are what's going to happen with interest rates. Now, I believe, we tend to look at the 10-year government treasury as sort of the barometer or benchmark for long-term interest rates. And that has seen a pretty significant bump over the last year, and certainly, again, another little bump here over the last month or so. But we think that there's a lot of resistance to the 10-year treasury, which is right around 2.7, maybe 2.8%. We see a lot of resistance of that up to about 3 for a lot of different reasons. So the Fed's kind of in a little bit of a pickle here. You have long-term interest rates that are not really willing to go up much higher, or we believe there's some resistance levels there. And well, they can't raise short-term interest rates too much because then you get the flattening of the yield curve effect, which is another mousetrap, so to speak, another sort of skeleton in the closet. So there's a lot of forces at work here. It's which one is going to overpower the other, I guess. And going back to what happened recently, inflation, it was such a powerful financial force. It really overwhelmed all of the other good possible forces that could affect the stock market. So you have all these kind of forces working together or against one another, and it's almost to the point of which one is going to win.
Yeah, and that's a good question for which we do not yet have an answer, obviously. But the Fed does seem like they're going to tighten. They're making proclamations that they're going to reduce the Fed's balance sheet, which is further, I don't want to say deflationary, but draining liquidity potentially from the market unless they print up the money and loan it to people to buy this stuff off their balance sheet, which the Fed is not above doing, let's face it. It's an interesting time. And at the same time, look, the employment numbers are good, but when you look at the U6, we still have 8% unemployment. The jobs that are out there, many of them, require highly skilled, well-trained members of the workforce, which that 8% probably doesn't belong to that category. What are we going to do here? It looks like as far as importing our workers in, H-1B visas, et cetera, that's going down. Are we really at full employment, or is there something that can be done with that 8% that aren't currently employed?
Well, yeah, that's a great question. And again, the answers are tough. I agree that, we're not close to full employment as you had suggested and with skilled workforce. And on top of that, our largest demographic of the workforce are the baby boomers who are retiring. I think the 10,000 a day or 10,000 a week. I forgot the number off the top of my head, but we have our skilled, baby boomer workforce that is moving to retirement, and we need to replace those workers and add on top of it. So it's a tough question with the immigration debates that have been going on now seems endlessly. Are we going to be able to replace the workforce, the skilled workforce? So, I unfortunately don't have a great answer for that either when it comes to, the unemployment numbers.
Even the high-paying, what you would call a semi-skilled job, working on an assembly line for one of the major automakers, you go into a factory there and all the workers there are white-haired or no hair. There's not a lot of young people who really want to be going into manufacturing, which is leading to a severe shortage in manufacturing industries and putting further pressure on wages and driving their costs up. So the fact that they've got this nice 15% cut in their costs effectively, assuming they were paying the full 35% tax rate, really relieves a little bit of that pressure, but they've got to do something here. And I guess the answer is going to be more capital investment.
Correct. We've seen companies, and that was really the big deal with the tax reform, is these companies moving overseas money, and we've seen it from the numbers. It looks like they're moving over trillions of dollars with a T here and reinvesting it. We're seeing it a little bit now in the form of bonuses, but again, all of this great news came out and it had almost a negative effect. I mean, the markets at this point are very fickle. When it comes to jobs reports, when it comes to these sort of dynamics.
Yeah, agreed. So, looking ahead here, all these numbers are well and good, and people do follow them. But what you really care about is, how does it affect you? How do you adapt for the potential here for what's going to happen? What do you do?
Well, again, I don't want to sound like everybody else, but certainly don't panic. It was easy to do so, and we saw that. I mean, the first words that came out of our mouth in our meetings yesterday was that term whipsaw, and we see that a lot historically. Now, a lot of the financial instruments that our sort of niche here, our boutique here in the financial world, is dividends and interest. So we focus heavily not on growth of financial instruments, not on price appreciation. We focus heavily on dividend producing financial instruments. So we're actually looking for growth through the dividend. Now, but stick to your guns. But even if your sort of strategies is not dividends and interest, you focus more on growth and price. Again, stick to your guns. Don't deviate. Don't get into this, getting out of it quickly based on, some news report or something like that. It's very, the news itself is becoming very sort of dramatic. When the Dow dropped over 1,000 points, that's how they described it, the biggest point drop in history. Well, that might have been true, but percentage-wise, it wasn't even close to the biggest single-day drop in history. So everybody's being a little over-dramatic sometimes when they announce these things. One last thing I'll mention is that these large point drops are going to start to be the norm. 200, 300, 400 points when the Dow is at 26,000 is much different than 200 or 300 point swings when the Dow is at 10,000. So percentage-wise, we kind of almost have to reevaluate the economics behind these numbers changes and don't get a little caught up sometimes in the dramatics of it.
Hey, that is a great point. And hey, Jason, we really appreciate you coming on the show. People want to find out more about what you guys do, connect with you. What's the best place to go to?
Yeah, just visit our website, which is ScrantonFinancialGroup.com.
ScrantonFinancialGroup.com. Hey, we'll have a link to it in the show notes of this interview. For more info or questions, comments, feedback, be part of the show. Email us, kl@kerrylutz.com. Twitter feed, which has gotten pretty active, and I have no idea why, is @KerryLutz. And the Facebook page is Financial Survival Network. Hey, Jason, thanks so much for being with us and attempting to clear things up. Sometimes there just is no clarity, and we just have to wait for the clarity. But we'll talk to you again real soon, and be well.
Thank you very much, Kerry. You too.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.